maybe that company is not able to go to a bank or maybe borrow what a loan. And therefore, the directors of that company maybe decide to sell one of the assets which is owned by that company, but because the asset is still used by the company, the asset will have to be released immediately afterwards, after the sale. So therefore, in case of a sales leaseback transaction, we say, and this whereby a company will sell an asset, basically will sell an asset. We say the company which sells the asset is called the seller. And basically, this asset will be sold to another company, which is called the buyer. And immediately, these two companies will enter into an agreement, or basically into a contract, that this company here will lease back the asset to the seller. So meaning that once the asset is basically sold, the asset then will be leased back to this particular company. So therefore, we say this company which is selling the asset is called the seller. This company which is buying the asset is called the buyer. Now, on the other hand, once these two companies have entered into this lease agreement, this company here, which now owns the asset, and which has leased back that asset, this company is called the lessor. Remember, in this case, we said the lessor. Basically, this is the owner of the asset. So if you are the owner of the asset, you are the person who is leasing out the asset. You are known as who? The lessor. And basically, the person who is given the right to use that asset is called who? The lessee. So therefore, this company will be known as the lessor, whereas this company here is called the lessee. So therefore, we can say in this particular transaction, that is in a sales leaseback transaction, we have two parties. We have two parties. Number one, we have the first party, who is called the seller lessee. The seller lessee. And actually, you see that these are the company or the entity which is selling the asset and immediately leasing back that particular good asset. So number two, we have the other party called the buyer lessor. So the buyer lessor is the company which is buying the asset and immediately leasing back that particular asset to who? To the seller lessee. Now, in this case, we are going to look on how this transaction is accounted for in the books of account of these two parties. So how does these two parties account for this particular good transaction? But even before we look on how this transaction is accounted for, according to this particular standard here, that is IFRS 16, for these two parties to account for this transaction, it is important to determine whether this transfer of the asset, or basically this sale of the asset, whether it is a true sale, or not. So that is the first thing the two companies need to determine. Is this a true sale or not? So basically, what does that mean? Now, according to another standard, which is IFRS finance or operating. So that basically what you need to know. But here we are saying what is very, very important are these formulas. These formulas which we have here, basically you must remember them. Then let's look on how this transaction will be accounted for if it is not a true sale. If it is not a true sale. So in this case, we have said this transaction will be regarded not to be a true sale, if, number one, the control of the asset is not transferred. The control of the asset is not what? Transferred. So it means that this company, despite having bought the asset, the company does not have the ability to direct how the asset will be used. The control has not been transferred. Number two, this will not be a true sale whereby the rewards and basically the risks which are associated with the asset equally are not what? Are not transferred. They are not transferred. The risks and rewards associated with the asset still remain with this person. So if then that is the case, this transaction basically is viewed to be like a loan arrangement. So if it is not a true sale, this transaction then amount to like a loan what? Arrangement. A loan arrangement. So basically when we talk about a loan arrangement, this whereby For example, you may be owning an asset, you approach a financial institution or basically a bank, and basically borrow money from them and use one of the assets which you own as a collateral security. So in most of the cases, the moment you're given that loan, what will happen is that the value, the current market value of the asset will be determined. And the loan which will be given, in most of the cases, will be equivalent to the market value of that particular asset. And that's why you see that anytime, for example, you go to a bank here, and maybe you want to borrow like a loan, and maybe use one of the assets which you own as a collateral security. So in most of the cases, the bank must do evaluation of this asset. What is the current market value of this asset? And therefore, the amount of the loans they will give you, in most of the cases, will be equivalent to what? To the market value of that asset. So therefore, if this does not amount to a true sale, the control is not transferred, the risk and reward are not transferred, then you are saying that this is like a loan what? Arrangement. So in this case, the amount or the sales profits, which is received by this company here, that is the seller receive, the sales profit received, this one will be treated like a loan. In other terms, this one will be treated like a financial liability, or this will be recognized as a financial liability, because now this company has sold an asset, it has been paid an amount of money equivalent to the fair value of the asset. So that amount of money which has been paid, we are saying that this one will be treated as a loan. Will be treated as what? As a loan. In other terms, this company will account for something called the financial liability. The financial liability, this one is equal to the sales profit. So how much amount was received after selling the asset? So that one will be recognized as a loan. Specifically, it will be treated as a financial liability. So on the other hand, this company here will be deemed to have given this one a loan. So therefore, the sales profits, remember this is now how the transaction will be accounted for by this company, the seller receive. The seller receive, we are saying, will just recognize the sales profit as a loan. And because the asset has not, the control of the asset has not been transferred, this company will continue accounting for that asset. This company will continue accounting for the asset in its books of account, and then the amount it received as a sales profit, we are saying will be accounted for as what? As a loan. What about now this company? What about now the buyer? The buyer as well. So the buyer as well will account for the sales profits paid, the sales profits paid as a loan given, as a loan which has been given. So a loan which is given, this one should be accounted for as a financial asset. This one should be accounted for as a financial asset. So this particular company has given a loan to this one. It will account for the loan given as a sales as a financial asset. This financial asset will be equivalent to the sales profit which was paid, which basically we are saying is like a loan this company has given to this one. So basically this one is not a very, very common, but you may come across a theory question whereby you're required to explain how does these two parties in a sales leaseback transaction account for this transaction in case there is no true sale, in case the transaction does not meet the criteria specified at the IFRS 15. Yes. So I think with that, with that, we can look on a question. We can look on a question from a past paper. I don't know whether there is any question before we look on a question. Is that well understood? Before we look on a question? Before we look on a question, is that well understood? Is that well understood? Is that well understood? I'm told by Dan it is well understood. Yes. Is that well understood, Maureen? Before we look on a question from a past paper? Okay, yes. So I'm told by Georgina is well understood. Okay, so let's look on a question. We have a very good question on that. A question which was tested in December 2021. December 2021, you go to question number 3A. December 2021. December 2021, question 3A. December 2021. Question 3A. Question 3A. So are you there? Do you have the question with you? If yes, please confirm. Please confirm. Are you there? Are you there? Are you there? Do you have the question with you? Do you have the question with you? If yes, please confirm so that we move together. Do you have the question with you? Yes, are you there? Are you there? That is I need some confirmation. Okay. So what are we told here? What are we told? We are told 𝐻𝐍 Limited sold a building at its fair value of shillings 112 million to a finance company on 31st of October 2020, when its carrying amount was shillings 78.4 million. So the building was leased back from the finance company for a 5-year period. The remaining economic useful life of the building was deemed to be 25 years, so it could be concluded that the control of the building had been transferred to the finance company. That information is very, very important, that when this company, which is called 𝐻𝐍 Limited, sold the building to a finance company, in that sentence we are told the control was transferred. So if the control was transferred, then this transaction amounted to a true sale. So if it's amounted to a true sale, then you have to remember what you have said. So what should be recognized, how should the 𝐻𝐍 Limited recognize for this, or recognize this transaction in its books of account? And then you're told the lease rentals are shillings 9,856,000 payable annually in arrears. The interest rate implicit in the lease is 7%. The present value of the annual lease payment was shillings 40.32 million. 𝐻𝐍 Limited recorded the cash proceeds. They recognized the building and recorded the profit on the sale of 33.6 million in the statement of profit or loss. No other accounting entries have been posted. So what are we required to do? We are told with the reference to IFRS 16 leases and with the suitable calculations, explain the accounting treatment of the above transactions in the financial statement of 𝐻𝐍 Limited or for the year which ended 31st of October 2021. So basically, it is important for you to note that here we have two companies. We have this company which is called 𝐻𝐍 Limited. This is basically the company which sold the building, and we are told the building was sold to a finance company, and immediately this company leased back that particular asset. Immediately leased back that asset. It basically means that this company here will be the seller, because it sold the asset, and after selling the asset, it leased back the asset. So this company is the seller, lessee, whereas this finance company is the buyer, lessor. Is the buyer what? Lessor. That is the first thing you need to know. And then we are told that the control of the asset was transferred. The control of the asset was transferred to this particular what? A company. So if the control is transferred, basically that amounts to a true sale. It amounts to a true what? Sale. So if it's a true sale, what have we said? We have said that this company, that is the seller, lessee, one will have to recognize that asset, remove that asset from the statement of financial position. 2, recognize the right of use asset. 3, recognize the lease liability. 4, recognize the gain or the loss on what? On disposal. That's what we have said. Then in the books of account of this company, we have said 1, this company will recognize that asset, recognize the asset, and number 2, this company will then proceed and account for that lease as either operating lease or basically as what? As a finance lease. As a finance what? Lease. That's what you needed to remember there. But what are we required in our question here? So, or what was the examiner requiring? The examiner was requiring, with reference to IFRS 16 leases and with suitable calculations, explain the accounting treatment of the above transactions in the financial statement of which company? In the financial statement of 𝐻𝐍𝐿 Limited, basically for 1 year, the year which ended 31st of October 2021. So even before we do any computation, we can say number one, or here we can say that this is a sales leaseback transaction, is a sales leaseback transaction, which amount to a true sale, which amount to a true sale, which amount to a true sale, to a true sale. Why? Since the control, or since 𝐻𝐍𝐿 Limited, 𝐻𝐍𝐿 Limited is the seller lessee, transferred the control of the asset, to the buyer, lessor. To the buyer what? Lessor. That is basically the first thing you needed to know, that this is a sales leaseback transaction, and it basically amounts to a true sale simply because the control of the asset was transferred. So if that is the case, then we have said that this company will basically will basically account for those like 4 items. They recognize the asset, recognize the right of use asset, recognize the lease liability, and then recognize the gain or loss on disposal. So we can proceed and we say 𝐻𝐍𝐿 Limited will therefore number one we say they recognize the asset. They recognize what? The asset. Remember, in this case, the asset here is specifically a building. Is specifically what? A building. So that asset will be recognized. It will be removed from the statement of financial position of 𝐻𝐍𝐿 Limited. Number two, we have said that this company will also recognize the right of use asset. Recognize the right of use asset, right of use asset. So how do we compute this one? Because that is what you need to remember, the right of use asset. The right of use what? Asset. So we need to remember the formula here. So the formula we have said we take what? I hope you can be able to remember this. We have said we take the previous carrying amount. And in this case, we have said the carrying amount of an asset, in other terms, is known as what? What is the other name for this? Carrying amount of an asset. Carrying amount, I'm told by Faith, it is the net book value. Is that correct? Maureen? Georgina, is that correct? Benson, is that correct? Carrying amount is the same with what? Yes, carrying amount in this case, you have said it is the same with the net book value. The net book value. And then you have said we multiply this with what? With the present value of the lease payment. The present value of the lease payment. Present value of the lease payment. And then we divide this with the fair value. The fair value, in other terms, we have referred to this as the sales proceeds. The sales proceeds. So these formulas we are saying are very, very important. So I want us, even before we move to the other item, which should be accounted for by 𝐻𝐍𝐿 Limited, we compute this. So can we go back to the question here? You tell me, before the asset was sold, what was its carrying amount? That information, we have it in paragraph, in sentence 1. before the asset was sold, what was its carrying amount or the net book value? Can you see that net book value? As I'm told by this, it is 78.4. Yes, so we are told in sentence 1, 𝐻𝐍 Limited sold a building at the fair value of 112 million to a finance company on 31st October 2020, when its carrying amount was 78.4. That is the carrying amount or the net book value of the asset before it was sold. We multiply that with this, the present value of the lease payment, and that is also given somewhere. It is given within paragraph 1, the last sentence. Within paragraph 1, the last sentence, and is given as what? Is given as the present value of the annual lease payment is 40 million. And we can work with all our figures in million of shillings, 0.32 million, 0.32 million. And then we divide that with the fair value, which you have said is the same with the sales what? Proceeds. So our asset was sold at an amount of how much? Our asset was sold at an amount of how much? Can you see the sales proceeds? Can you see the sales proceeds? So this building was sold by 𝐻𝐍 Limited to a finance company at an amount of how much? Who can see that amount? Who can see that amount? Who can see that amount? Yes, that amount is within paragraph 1. The building was sold at the fair value of the sales proceeds of 112 million. So this is basically how we compute the right of use asset, So this will give us an amount of how much? Compute that particular amount. You give me the final figure. Compute that amount. Compute that amount. So I'm told by Ismail, it will be 224 million. 224 million. Is that what you're getting? At least you're getting 2-1. You're getting 2-1. Don't loud off, because I think the answer you're getting is in 3 decimal places. Don't loud off. Is it 224 or 2-1? It should be 224. 224, yeah? Yes. So then, other than recognizing this, number 3, we have said that this company, the seller 𝐻𝐍, will also recognize the gain or the loss on disposal. The gain or loss on disposal. But in this case, if you check the information you have in paragraph 1, we are given the sales proceeds. The asset was sold at 112 million, but its net book value was this. Automatically, this asset was sold at a gain. So therefore, this company will recognize the gain on sale. The gain on sale. How do we compute this gain on sale? You also need to remember this formula, very important. So we take the normal gain. The normal gain will be, we have said, is equal to the sales profit minus the net book value. We multiply that with the fair value minus the present value of the lease payment, and then we divide that with what? With the fair value. So let's compute this. Let's work out this. We compute this. So we take the normal gain. The normal gain will be equal to, maybe I can have the formula here. This one is equal to the fair value or the sales profits minus the net book value. So the fair value is 112. The net book value is this. So this will be equal to 112 minus 78.4. That will give us the normal gain. We multiply that with the fair value, which is 112 minus the present value of the lease payment. Present value of the lease payment is this, 40.32 million. Minus 40.32 million, and then we divide that with the fair value. The fair value is 112. The fair value is 112 million. So give me the final figure there. You give me the final figure, So the final figure in this case will be the gain. Will be the gain on disposal. The gain on disposal. The gain on disposal. What are you getting here? What are you getting? What are you getting? What are you getting, sir? Yes, that is the amount I'm given, 21.504 million. 21.504 million. So that is basically how we compute the gain on sale to be recognized. And then finally, number 4, we have said the seller lessee will also recognize something called the risk liability. We'll also recognize the risk liability, and the risk liability, this one, risk liability, this is equal to the present value of the present value of the risk payment, or the present value of the minimum risk payment. And actually, this value has already been computed for us, though even if it was not computed, there is how we compute that. Remember, we say that in this case, we take the minimum risk rentals, we discount that using the interest rate implicit in the risk. The interest rate implicit in the risk is given in paragraph 1 in the second sentence from last, which is 7%. And then the risk payment, this payment is also given as 9,856,000. So naturally, remember that this particular asset was leased back for 5 years. The asset was leased back for 5 years. So to get this, which has already been computed for us as an amount of 40.32 million. So this one should be equal to this one, if it was not given, should be the present value of this. 98,56,000 times the present value interest factor of annuity at the rate of 7%, this one, and basically for 5 years. For 5 years. So we should give us the same value here. So remember the formula for computing this. So you should take 9856, and then the formula here is 1 minus 1.07 raised to power negative 5 all over R, which is 0.7. Can you confirm whether that will give us the figure we have up there? 40.32 million. Is that what you'll get if you work out this? 1.07 raised to power negative 5, 1 minus answer divided by, sorry, this should be 0.07. Yes, it's coming to around 41. I think this one has been rounded off, but it's coming to the same value. Are you getting the same value? Are you getting the same value? The same value? The same value, is that what you're getting? The same value? Just the present value of this. The present value of this, or this times the present value interest factor at the rate of 7% for 5 years. So that should give us the same. That should give us what? The same. But I think in that case, the examiner had simplified the work by basically providing that value. Are you getting the same value? Are you getting the same value you want us to remove? Are you getting the same value? The same value? Yes, yes. So, okay. So then let's proceed. Let's proceed, please. Let's proceed now. Let's proceed. So these are basically the what these companies should do. One, they recognize the asset, recognize the right of use asset, recognize the gain on the sale, recognize the lease liability. Then we need to proceed and we make the accounting entries. We show the accounting entries. The accounting entries which were made by this company on the date this transaction took place. Remember, this transaction took place at the start of the year, or when the date took place. It basically took place on 31st of October, 31st of October 2020, 31st of October 2020. So what was the double entry which was effected in the books of account of this company? So one, we are saying that this company will recognize the right of use asset. This right of use asset should be recognized in the books of account of this company as an asset. So the first account to be debited is the right of use asset. And this account will be debited with this particular amount here, 28.224 million. The other account to be debited is the bank account. Remember, our company sold the asset. The amount which we debit in their bank account is equivalent to the sales proceeds. Our company sold the asset here. It received an amount of 112. That should be debited in the bank account. Debit the bank account with that amount. Yes. So these are the two accounts to be debited. Then we proceed and credit a number of accounts. The first account to be credited is this one, the lease liability. The lease liability account. The lease liability will be credited with this amount, 40.32 million. So because this is a liability in the books of this company. Number two, this company will also credit the income statement. So this particular gain on sale, the gain on sale is an income. Being an income, it is supposed to be credited in the income statement. This one, the gain will be credited in the income statement, or basically the statement of profit or loss. The gain on sale, this amount here, 21.504 million. Yes, that is the other account to be credited. So there is still another account to be credited, because remember what you have accounted for is this. We have accounted for the gain. We have also accounted for this one, but you have not yet accounted for this. So once the company sells an asset, then what will happen is that the company will credit the buildings account. Basically, to credit the buildings account is to recognize the buildings this building should be removed from the buildings account. That's why we are crediting buildings. So we credit this account with the net book value. How much is the net book value? Is this one, 78.4 million. 4 million. So those were the accounting entries which were supposed to be effected on the date this transaction took place. And the amount which has been debited should be equal with the amount credited. Can you confirm whether this plus this is equal to all this? That should be the case. Because remember, whenever you're making an accounting entry, the amount to be debited, the amount to be credited should be the same. We are saying this should be the same with that. Is that the case? Is that the case? Is that the case? Is that the case? Is that what you're getting? I'm getting a yes from Phoebe. I'm getting yes from Faith. Is that what you're getting? Yes, 140. I'm told is 140. 140.224 million. Yes, so that should be the case. So are we done with the question? Have we completed the question what the examiner was requiring? Not yet. That's why you can see the marks allocated here were significant marks, 8 marks. Now, if you check on the requirement, we are required basically to show the accounting treatment of this transaction in the financial statement of 𝐻𝐍𝐋 for the year which ended 31st of October 2021. And remember, this transaction, it took place on this date. Basically, this is like the transaction took place at the end of the previous year. And actually, the end of the previous year is the same with the start of the current year. So we can say this transaction took place at the start of this year. But if you check on what we are required basically to demonstrate how it was supposed to be accounted for in the financial statement of this company. Now, we need to proceed. And basically, we do two things. One, we need to depreciate this right of use asset because that depreciation for the current year on the right of use asset will be recognized as an expense in the income statement. Other than determining the depreciation on this, we also need to amortize this. So why should we amortize this liability is for us to determine two items. The interest to be recognized in the income statement for the current year. And number two, for us to determine the lease liability to be recognized in the statement of financial position. I think first of all, we can compute the depreciation on the right of use asset. Depreciation on the right of use asset, which will be equal to the value for the right of use asset, this one, 28.224 million. And then, how do we depreciate this? We say this one should be depreciated at what? At the shorter of two periods. Shorter of two periods. I hope you can be able to remember those two periods. One, there is term, and number two, the remaining economic life of the asset. The remaining economic life of the asset. So this company had limited leased back this asset for how many years? Had limited leased back the asset for how many years? In the first paragraph, sentence 2, we are told the building was leased back from the finance company for 5 years. The lease term are 5 years. 5 years. And then we are told the remaining economic useful life of the building were 25 years. 25 years. So we will depreciate this on a straight-line basis at the shorter of these two periods. The shorter of these two periods should be 5. So that will give us the depreciation per annum. So what will be the depreciation per annum here? The depreciation per annum, what are you getting? 28.224 divided by 5. So that will give us what? That will give us 5.6448 million. Then where are you getting 1.1? This one should be 5 points. Next size, is that figure correct? Yes, which figure are you getting here? Please talk to Mwalimu here. Please talk to me. Please talk to me. Please talk to me. Please talk to me. Okay, yes. So that is basically the figure which you're getting. So remember, this depreciation, this one is an expense in the income statement because we are required to demonstrate the accounting treatment, or basically the accounting treatment for this transaction. We will prepare the income statement extract for the current year only. We show this there as an expense. Number two, we also need to do what? To amortize this liability. We need to amortize that. And basically, we amortize that by preparing the lease amortization schedule. There is amortization schedule. There is amortization schedule. So in this case, we have a column for years. For years, then the other column here will be for the lease liability at the start. Take into account our minimum lease rentals are payable in arrears. I hope you can remember that information. The lease rentals in the first paragraph, I think the second sentence from last, the lease rentals are 9856 payable in arrears. So if they are payable in arrears after the lease liability, our next column here should be for the interest, which will be computed at the rate of 7%. The interest rate implicit in the lease. And then the other column here should be for the cash to be paid. That is the minimum lease rentals paid annually. And then finally, the lease liability at the end of the year. At the end of the year. Yes. So we start with the first year. The first year ended 31st of October 2021. And we start with the lease liability at the start. The lease liability at the start of the year is what we have here, 40.32 million. Then we compute the interest, which will be 7% of that. What will be 7% of this? 40.32. 40.32 times 7%. 7%. What are you getting as the interest? What are you getting as the interest here? What are you getting as the interest? The interest. I'm not getting the answers. What were mechoka? Yes, please give me the answers. Stay in the chat box. Please give me the answers. Please give me the answers there. Please give me the answers. I'm waiting for the answers. There. Yes, it will be 2.8224. So how much cash will be paid by our company here? How much cash will be paid by our company, or how much amount do we consider here? The cash paid. The cash paid, remember, is the same with what? The minimum lease rentals payable annually. The minimum lease rentals payable annually. The minimum lease rentals payable annually is, I think, within the last sentence of paragraph 1, which is an amount of how much? Which is an amount of 9.856 million. So give me the lease liability at the end. The lease liability at the end, remember, this one is equal to our lease liability at the start plus interest minus the cash paid. This one would be equal to A plus B minus what? Minus C. So what will be the lease liability at the end of year 1? The lease liability at the end of year 1. This plus this minus that. Yes, what are you getting here? 33.2864. That is 3.2864. Yes. So that is the lease liability. Now, in this case, remember, we want to prepare financial statement extract for the current year. So first of all, this will be recognized in the income statement as what? As an expense. But for us to be able to determine the amount of the lease liability, to be recognized in the statement of financial position, we must prepare this amortization schedule for, I think, the next 1 year, such that we have now the lease liability here. Because the lease liability which we have here, remember, this one is what we recognize in the statement of financial position as a non-current liability. And then the difference between the two is what we recognize as a current what? Liability. So we must also prepare this for the next year, the year which ended 31st of October 2022. So this crossing balance will be the opening balance here. Then we compute the interest. We less the cash paid. So that we get this. How much is the interest for this year? 7% of this. $2.33. Yes. So give me this one. The lease liability at the end of the year. The lease liability at the end of the year. The lease liability at the end of year 2. Risk liability at the end of year 2. Risk liability at the end of year 2, I'm given by Mercy 25.7604. Yes, and I think now having that, we can finalize by preparing the financial statement extract. I want us to start by preparing the income statement extract. Basically, remember, we are preparing this only for 1 year, the year which ended 31st of October, 2021. So in the income statement, you have said this company, there were 2 items which were supposed to be recognized here, 2 items, the depreciation and this interest. So basically 2 items were supposed to be recognized here, items of expenses. One of it is the depreciation on right of use asset, which you have computed here, 5.6448 million. And the other one is this interest, this one. The interest, of which this interest, we said in the income statement, it should be recognized here as part of the finance costs. As part of the finance cost, which is an amount of 2.8224 million. So this is what our company was supposed to recognize within the income statement, 2 items of expenses. Finally, we prepare the statement of financial position. Statement of financial position. Still, remember, this is an extract. This is an extract. This is basically an extract. An extract. So here we have like 3 items. The first one under the non-current assets. The first one under the non-current assets. Under the non-current asset is this one, the right of use asset. The right of use asset. And remember, these are statements of financial position extract for the year which ended 31st of October 2021. So under the non-current asset, this company was supposed to recognize the right of use asset, of which this one will be recognized here at the net book value. The net book value will be equal to the cost, this one, 28.224 million minus the depreciation for 1 year. This depreciation, 5.6448 million. So that will give us a net book value of how much? Will give us a net book value of how much? What will be the net book value for our right of use asset? The net book value, I'm told, is what? Is 25. Okay, that should be this one. Oh, it's the same. It's the same with this one. No, it is 22. 57.52. Yes. So then from there, the next item to be recognized is the risk liability. The other item to be recognized is the risk liability. The risk liability. The risk liability. Okay. So this risk liability, remember, part of it will be an non-current liability. So under the non-current liability here, we will have a risk liability, and under current liability still we will have risk liability. So remember, we say that the amount to be recognized under the current liabilities here should be the difference between these 2 values here. Should be the difference between these 2 values. That difference should be recognized here as a current liability, the amount payable within the next 1 year. The amount payable within the next 1 year. How much is the difference between these 2 values here? The risk liability at the end of year 1, the risk liability at the end of year 2. The difference is coming to how much? 7.526. Yes, so that is also the figure I'm getting from Odin. Yes, so then the amount to be recognized as the non-current liabilities at the end of year one, this one, we said we take the lease liability at the end of year two. This is now going to be recognized here as a non-current liability at the end of year one. So this one, 25.7604 million. 25.76.04 what? Million. So that basically what was required in that question. That is what was required in that question, of which you can see that question was a little bit demanding because basically you needed to recognize all that. You needed to remember all that. That this company had limited, because this amounted to a true sale, one, will recognize the asset, number two, recognize the right of use asset, number three, recognize the lease liability, and number four, recognize the gain on the sale. And then from there, you have said that these two items here, the right of use asset should be depreciated at the total of the two periods, and then lease liability should be amortized. Should be what? Should be amortized. And I hope you can see that in this question, the examiner was requiring you just show the financial statement extract for 1 year, because if you're required to show that for how many years? For 5 years, then the question would be involving or would involve a lot of work, because you have to prepare this for the next 5 years. And then when preparing this financial statement extract, for example, the income statement extract, you prepare that for 5 years. The statement for financial position extract, you also prepare that for 5 years. So that's why you can see the examiner just required the preparation of this for 1 year, because you can see the work is quite what involving. So that is it. That is what was required here. That is what was required here. Let me ask, even before we move to something else. Now, if, for example, you're required just to briefly explain how the finance company was supposed to account for this transaction. Remember, we have said that this company, 𝐻𝐍 Limited, we have said was the seller receipt, whereas now the finance company was what? Was the buyer resort. So in this case, assuming you're required just to explain how this company should account for that transaction. Assuming you're required just to explain how this company was supposed to account for that transaction. So what have we said here? This company will do what? We have said our company will do two things. Who can be able to remember the first thing we have said? The buyer resort should do. We have said that company should account for the two main transactions. We have said the first thing to be done by that company in its books of account is to do what? To recognize the asset. That is the first thing we have said this company should do. Recognize that particular what? Asset, simply because the control was transferred to this company. So the first thing this company will do is to recognize the asset. And basically, to recognize the asset, this company should simply debit the building's account because it bought the building, and then credit bank, because you can be required to basically explain that, and you support that with the accounting entries. So this building was bought, remember, was bought at 112 million. 112 million. So this company recognized that building in its books of account at that amount. 112 debited in the bank, in the building, and that is the same amount which was paid to be credited in what? In the bank account. Number two, we have said, other than this company recognizing the asset, the company then will proceed and account for the risk. Account for the risk. Account for the risk. And this company will account for the risk, or will basically have to determine whether this risk is a finance risk, is a finance risk or an operating risk. Or an operating risk. And basically using the information which are given here. Using the information which we have in this question here. Now, from the finance company's point of view, is this an operating risk or is it an operating risk? From the information which we have here in this question, is this an operating or a finance risk? You have to recall the criteria we discussed in our previous class. Which criteria should be used by the owner of the asset in terms of determining whether the risk is a finance or an operating? Which criteria can we use here to evaluate whether this is an operating or a finance? I can see a criteria there. I can see a criteria there. I think we only have one. Remember you talked about the option to buy, the transfer of ownership, whether the lessee can be able to use the asset without major modification, whether the present value of the minimum lease rentals is equal to the fair value, and the issue to do with the lease term, whether the lease term, yes, that is the criteria we're going to use, the one which are given by Faith here. That is the criteria we're going to use. Remember, we are told that this asset was leased for how many years? Was leased for 5 years. This is the lease term. We said you take the lease term, divide that with the remaining economic life of the asset. The remaining economic life of the asset, we were told were 25 years, and then we express that as a percentage. We express that as a percentage. And actually, we say if you get a rate which is 75% or more, 75% or more, that automatically is what? Is a finance risk. If you get a rate which is less than 75%, is an operating what? Risk. Yes. So this will give us what? 1, 5, 1, 2. So this will give us 20%. So you can see here, you can see the rate which you're getting is basically less than 75%. So if it is less than 75%, what does that mean? Is this a finance or an operating risk from the owners, from the buyer's resort point of view? Is this an operating or a finance? Yes, this one is automatically an operating risk. This one is an operating risk. We have said that if you get a rate which is less than 75%, is an operating. But if you get a rate which is 75% or more, is basically what? Is actually a finance. So therefore, if, for example, you're required just to explain how the finance company was supposed to account for this risk, one, you say it will recognize for that asset, you can support that with a double entry here. Number two, account for that risk as either operating or finance. And you have said, as per the information which you are given here, this risk will be an operating. So if it is an operating, what does that mean? It basically means that this company that is the finance risk will just be accounting for the minimum lease rentals receivable. This company will be accounting for the minimum or for the lease rentals receivable, the lease rentals receivable is basically what? Part of other incomes in the income statement. So the amount of lease payment, which is the 9,856,000, this is what our finance company will be accounting for as an income each year. As an income each year, because this risk does not qualify to be classified as what? To be classified as a finance what? To be classified as a finance risk. So that basically what you need to know. You can see accounting for this a little bit technical from what we have already covered, because so far we have looked on how the risks are accounted for by the owner and also by the lessee. So there was not much complication, but you can see this one is a little bit what? Technical. You need to basically understand what you're doing. So I want just to guide you for that. There is another question which is part of the handout which I've shared with you. Can we go to that question? We are not doing it, but I want to give that as an assignment. That is an assignment. So in the 𝐎𝐍 WhatsApp group, in the 𝐎𝐍 WhatsApp group, in the 𝐎𝐍 WhatsApp group, the 𝐎𝐍 WhatsApp group, there is a handout which I've shared there. Yes, is everyone in the 𝐎𝐍 in the paid WhatsApp group? Or we have some new students who are not in the paid group? I think everyone should be in the paid group here. Okay, so are you there in that illustration, in that handout? So if you're there, I want us to briefly go through that small illustration, and then you'll do it as an assignment. You'll do it as an assignment. Okay, so what are we told there? What are we told? What are we told? We are told on 1st January 2021, 𝐎𝐍𝐋𝐿 Limited sells an item of machinery to XYZ Limited for its fair value of shillings 3 million. The asset had a carrying amount of shillings 1.2 million prior to the sale. So we are told these sales represent the satisfaction of performance obligation in accordance with IFRS 15, revenue from contract with the customers. So basically, we are told it do what? The sale represents the satisfaction of the performance obligation. It basically means that this particular transaction here amount to a true sale. It amount to a true sale. So if it is amount to a true sale, then you have to remember how the two companies will account for that. So it amount to a true sale in accordance with IFRS 15. And then you are told 𝐎𝐍 Limited entered into a contract with XYZ Limited for the right of use, for the right to use the asset for the next 5 years. And then you're told the annual payment of 500,000 are due at the end of each year. And then you're told that the interest rate implicit in the lease is 10%. The present value of the annual lease payment is 1.9 million, and the remaining useful life of the machine is much greater than the lease term. Much greater than the lease term. So if it is much greater than the lease term, that basically information is to help you to know whether this lease is operating or finance from the buyer's and the seller point of view. So if you are told the lease term, not the lease term, the remaining useful life of the asset of the machine is much greater than the lease term. What does that mean? Should that lease be a finance or operating? Should that lease be finance or operating? Should that lease be finance or operating? So remember, you are told that the remaining economic life of the asset, this one is greater than the lease term. Should this be a finance or operating lease? A finance or operating lease? Finance or operating lease? So remember, in our case, what we are told, this asset was leased for how many years? Are we given the lease term? Are we given the lease term? Yes, the lease term are 5 years. 5 years. 5 years. And actually, we are told that this one is greater than what? Than this one is greater. So does that mean that this lease will be a finance or operating? Because that is information to help you. That is the information to help you. I'm told it is operating. I'm told it's yes. Operating, finance, operating or finance. So remember, in our case here, what we say is that basically a lease shall be regarded to be a finance lease if the lease term is for the major part, of the remaining useful life, life. But in this case, if you are told this is greater than this one is greater than this, automatically that is an operating lease, because if this is a finance lease, this one should be greater than this one. Sasa, yes. So this one would be classified as an operating lease. So what are we required to do here? We are required to explain the treatment, explain how the transaction will be accounted for on January 2021 by both 𝐻𝐶 Limited and �XYZ Limited. So basically, number one, you have seen that this transaction here is a true sale, and basically what you just need to say is that that is 𝐻𝐶 Limited, which is the company which sold the asset. Number one, because it is a true sale, it will recognize the asset. Number two, it will recognize the right of use asset. Number three, it will recognize the risk liability. And number four, it will recognize the profit or the gain on disposal. And basically, you have to compute the values which must be computed, especially the gain on disposal and also the right of use asset. Then after doing that, after explaining that, you must make the accounting entries. I hope you can remember the accounting entries which I've made for the other question. Make the accounting entries. Then on the other hand, you will say, because this amount to a true sale, this company which is called XYZ Limited, number one, will have to recognize the asset. So, and basically in that case, support that with the accounting entry. So this company XYZ will recognize the asset by debiting the machine account with the value at which the machine was bought. The machine was bought at 3 million, and then credit bank. Credit what? A bank. And then you will also say that at the end of this year, this company will account for this lease as an operating what? As an operating lease. As an operating what? Lease. As an operating lease. But basically, for you to be able to even understand what you have done here, I will request you do that question. You explain how it was supposed to be accounted for in the books of account of the two companies, in the books of account, and also in the financial statement of the two companies for the first year. The year now which ended 31st of December 2021. So in the books of account of the seller receipt, you will basically have to make the accounting entries in relation to the recognition of the asset, right of use asset, the risk liability, the gain on the disposal. Then from there, you'll have to depreciate the right of use asset. You prepare this risk amortization schedule for the first year, and then you show the financial statement extract. Then also in the books of account of the buyer SO, after making the accounting entries for the initial recognition, at the end of the year, you have seen that company will do what? Will reflect this asset in the statement of financial position. It must also depreciate that asset, and also the lease rentals receivable will be recognized in the income statement as part of the other incomes. As part of the other incomes. Maybe you can just prepare the financial statement extract in the books of account, or actually in the books of account of these two companies for the first year. For the first year. Yes. So that basically what you need to know as far as the sales leaseback transaction is concerned. And that brings us now to the end of that topic on leases. So basically, you need to remember what you have discussed here. What is the lease? How the lease is accounted for by the owner, that is the lessor. How the lease is accounted for by the person who is given the right of use asset, that is the lessee. And also how we account for what? The sales leaseback transaction. Especially this one, we have said you need to understand this because you can see it's a little bit more technical. And basically that means that once we meet in our next class, we will be moving to a new topic. I'll be able to see which topic we will start in our next class. We will start in our next class. I'll be able to see whether we do, there is a small topic which is the remaining share-based payment, or basically the topic on external reconstruction, because I think from there, we should be starting the group account anytime from now. But I will be able to see what we will be able to start in our next class. So I want us to stop at that point. I don't know whether there is any question before we wind up. Any question before we wind up? Is there any question? Any question before we wind up? Okay, so I think there is none. There is none. There is none. So we stop at that point for today. Have a nice evening. We continue from there next week on Tuesday. So have a nice weekend and also a nice evening.